Hey there, future chartered accountants, ready to crush another scoring topic for your SPOM exam? Today, we're diving into sections 248 to 252 of the Companies Act, striking off of companies. This section is a goldmine for exam questions and marks, so buckle up. We're making this as clear and engaging as possible. Let's go. Section 248. When can the registrar strike off a company? Let's start with the basics. Section 248 tells us when the Registrar of Companies, or registrar, can strike off a company's name from the register. This can happen in two ways. 1. Suo motu action by registrar on its own. 2. Company's application, when the company requests it. Let's break these down. 1. Suo motu action. The registrar can take action if any of these three situations arise. First, if the company hasn't carried on any business for 1 year from its incorporation. Second, if the company hasn't filed financial statements or annual returns for 2 consecutive years. Third, if the company hasn't filed mandatory forms like I-20A for commencement of business, due within 180 days from incorporation. I-22 for registered office details, due within 30 days if not declared during incorporation. In these cases, the registrar issues a notice of intent to strike off the company and gives it 30 days to respond. If the company doesn't provide a satisfactory explanation, the registrar moves forward, striking off the company's name and publishing a notice in the official gazette. That's it. Bye-bye company. 2. Company's application. Now, what if the company itself wants to be struck off? Here's the checklist for this route. 1. All liabilities must be settled. No debts left hanging. 2. A special resolution must be passed in a general meeting. 3. Consent from 75% of members by value and paid-up share capital is required. Important note, if the company operates under a special act, like banking or insurance, it also needs approval from the relevant regulatory authority before applying. If all these conditions are met and the registrar is satisfied, the company's name is struck off, and a public announcement is made in the official gazette. But directors and members are still liable for any outstanding liabilities or assets. No escape, folks. Section 249. When strike-off is not allowed. Next up, Section 249. This tells us when a company cannot apply for strike-off. Here are the red flags. 1. If, in the last 3 months, the company has filed a winding-up application that has been accepted, had significant accounting transactions like sales, purchases, or dealing with assets, a compromise or arrangement scheme under the Companies Act pending, changed its name or office address in a way that suggests ongoing business activity. Moral of the story? If you're actively operating or winding up, strike-off isn't an option. Section 250. What happens after strike-off? Now, Section 250 reminds us of a key fact. Even after a company is struck off, the directors and members are still liable for all the company's outstanding liabilities and assets. The date of strike-off is also treated as the date of dissolution. In short, strike-off doesn't mean freedom from responsibilities. Section 251. Fraudulent strike-off is big trouble. Section 251 is all about consequences for fraud. If directors or members use fraud or misrepresentation to get a company struck off, they face punishment under the dreaded Section 447. So, play fair, because penalties under Section 447 aren't a joke. Section 252. Reviving a struck-off company. Finally, Section 252 deals with the revival of struck-off companies. A company can apply to the National Company Law Tribunal, or NCLT, for restoration. But who can apply, and what's the timeline? The registrar can apply within 3 years from the strike-off date. Company members, creditors, or workmen can apply within 20 years from the strike-off date. Others, like interested parties, can apply within 3 years. If the NCLT approves the application, the company's name is restored to the register, and it's as if the strike-off never happened. Talk about a second chance. Conclusion. Striking off equals scoring topic. So there you have it, sections 248 to 252 in a nutshell. This topic is highly scoring, and examiners love to ask about the conditions, timelines, and liabilities. Quick recap. 1. Section 248, how and when a company can be struck off. 2. Section 249, when strike-off isn't allowed. 3. Section 250, liabilities, post-strike-off. 4. Section 251, fraud consequences. 5. Section 252, Revival Registraris through NCLT. Make sure to revise this thoroughly and ace those questions in the exam. And that wraps up today's session on striking off of companies. If this breakdown helped you, hit that like button and share it with your study buddies. Best of luck, keep grinding, future CAs.